What's up, you guys? Hope you guys are doing well. So here are 3 very important analysis traps to avoid when trading and their counterpart too. So let's get into it. The first one is not taking into account the narrative of the market. So where are most of the institutional investors going to? Where are most of the retail investors going to? Etc. If you just focus solely on yourself, but you ignore everyone else, you're going to have a very hard time trading in this market. So empathy is a very underrated aspect to trading. So try to figure out where the average person would go to, like Bitcoin, Ethereum, Doge. So for example, if I was an average person, I was getting into crypto, I would think, okay, I want something cheap, something attractive like Doge. Bitcoin's a little bit too expensive, maybe something like Bitcoin, like Litecoin, Ethereum, maybe a meme coin or something. And for institutional investor, I want something that has a great amount of return, but is safe. So maybe something in Bitcoin, or maybe what's safe like Bitcoin but has more returns, maybe something like Ethereum, maybe something like Cardano, Polkadot, etc. And taking into account the narrative of the market allows you to find the trend of the overall market, so which direction it's going to, and which coins have the most volume, which allows that trend to be even stronger. And the inverse is to avoid getting too emotional with the narrative, right? So there are groups of people, maximalists as they're called, where they think, oh, only buy Bitcoin, only buy Doge, only buy Ethereum. If you fall into this emotional trap, you're going to ignore all the vast opportunities there are in the market. So try to be unemotional, see things as the way they are, which will be really hard, and you'll be good. The second trap is not taking into account fundamentals. So for example, just only buying into meme assets like Doge or random companies that don't really have that much fundamental value, and they'll probably pump and then dump a few days later. So you want something that has a mix of both, right? That has a strong narrative, but also has strong fundamentals backing it up. So whether their outlook is good for the future, next 5, 10 years, whether they're actually profitable, what projects they're going, which collaborations, etc. So you can do this by following them on different news straight from their official websites, or maybe a aggregate news thing that compiles all the news on your watch list, etc. And the inverse is selling the news events. So for example, the Doge SNL event, a lot of people expected Elon Musk to pump Doge on the interview. So this creates a self-fulfilling prophecy where people start buying into Doge early on, a couple days, a week or two before. So this is where the smart money sells right before the event or during the event, which causes the price to tank down. So people panic, they start selling, which creates a more momentum in the selling direction. It dumps 40-50%. Then the smart money comes back in, they swoop in on a dip, and then they start pushing more news that, oh, buy back Doge again when they already bought Doge, like when it was at that 40-50% dip. So try to play before and after news events and to avoid FOMOing into that trap where you hold your asset through the events, as that is gambling it too risky. And the very last trap is not taking into account technicals. So even if an asset is very strong fundamentally, buying in near the tops and then panic selling near the bottoms, well, it's just a recipe for disaster, right? Which is what 95% of people do. So you can make this easier on yourself by just following a few technical indicators. You can draw random channels. You can just check RSI when the asset is at an extreme level, when it's like 20-30 RSI or something on a 4-hour daily chart. You can just buy in, hold it. When the asset becomes overbought, maybe becomes 80 RSI on the daily or something, so whatever you prefer, MACD, RSI, whatever, you just sell it, or even like near the top of the channel that you wrote down or something. So try to take into account the technicals as fundamentals are important for the long term. However, technicals are also important short term too. So the inverse is to not over rely on them, as the narrative, the emotional backing behind a certain asset is oftentimes more powerful than the technical indicators, as technical indicators confirm the fundamentals and narrative, not the other way around. So for example, Ethereum just gapped up like crazy from 2K to 4K. So around 2.8K, 2.9K, the technical said that Ethereum is overbought. However, the narrative of the market was that Ethereum was the more profitable asset besides Bitcoin. And then recently the Ethereum killer narrative died out. So then Ethereum is back into the spotlight. And the narrative for it is that it is an undervalued asset that will probably flip Bitcoin. So that was very attractable, along with institutional investors showing their Ethereum holdings when they were accumulating Ethereum for the past year, and also a lot during January, March, February, etc. So hope these 3 tips help, and the most important thing to take away from this is to not go too extreme in these analysis traps, and don't be so hard on yourself if you do fall into these traps. Just recognize you're falling into the trap, then take a little break, see it as how it is, and then create your action plan from there. So hope these 3 tips help, and talk to y'all next time.